Welcome to my channel EcoTutor. Good morning students. Today's my topic is measure national income by different methods. So the first method of measuring national income is product method. Product method, this is also known as value added method. Product method and value added method. So product method, when we measure the values of all goods and services in value added method, it is an addition to the value of intermediate goods. So in this product method, the first component is value of output. This value of output, which is identical or equal to sales plus change in stock. Now this value of output, it includes the value of output in the primary sector, the value of output in the secondary sector, the value of output in the tertiary sectors, which is equal to the sales plus change in stock. Here sales in the primary sector, sales in the secondary sectors, sales in the tertiary sectors, and this change in stock, this is the difference between closing stock and opening stock of the goods and services. Here by closing stock we mean when we estimate the goods at the end, this is called closing stock, and when we estimate the goods in the beginning, this is called the opening stock. The difference of these two, that is closing stock minus opening stock, is equal to change in stock. Now in this value of output, identical or which is equal to the sales plus change in stock, we deduct the value of intermediate goods, we will have the gross value added at market price. Which is equal to GDP at market price. In the previous video, we explained the market price, factor cost, national income and its related aggregates. Now, value of output or sales plus change in stock minus value of intermediate goods, we will have GVA at market price. G means gross, V means value added at market price, and GDP at market price means gross domestic product at market price. If we deduct now depreciation, which is also known as consumption of fixed capital, fixed capital it is also known as expected obsolescence. So when these values such as depreciation, consumption of fixed capital are subtracted from GVA at market price or GDP at market price, then we will have NVA at market price, or you can say that NDP at market price. GVA at market price or GDP at market price minus depreciation, or you can say that consumption of fixed capital or expected obsolescence. These values are subtracted from GVA at market price and GDP at market price. We will have net value added at market price, and you can say that net domestic product at market price. If we deduct the NIT, this is NIT is it is the difference between indirect tax, taxes minus subsidies. Then we will have this NIT. NIT is the difference between indirect taxes and subsidies. By deducting this NIT, net indirect tax, from net value added at market price or NDP at market price, we will have NVA at factor cost, or you can say that NDP at factor cost. And this NDP at factor cost, it is equal to the income of the factors of production in the domestic territory by land, labor, capital, entrepreneurs. So if we add this in this NDP at factor cost or NVA at factor cost. This component that is known as net factor income from abroad, somewhere it is written like this, net factor YA. This is the net factor income from abroad. We will have NP at factor cost, which is equal to national income. So this way, in the product method, we calculate the values of national income like this. So let's remind. First of all, we should have the value of output or sales plus change in stock. We must know these values. From these values, we minus or subtract the value of intermediate goods. Intermediate goods such as raw material. We deduct these values from these value of output, which is equal to the sales plus change in stock. We will have GVA at market price oblique GDP at market price minus depreciation oblique consumption of fixed capital. We will have net value added at market price, or you can say that NDP at market price minus NIT. This is NIT is the indirect taxes minus subsidies, and when we deduct this NIT from NDP at market price, we will have net value added at factor cost oblique net domestic product at factor cost is equal to NP at factor cost oblique NY, which is known as national income. Now, next method, that is income method. Income method of measuring national income is, it is the sum of domestic income and domestic income equal to the domestic income equal to the COE plus OS plus MI. COE means three components are there in COE: wages oblique salaries in cash or kind. Second one is employers contribution towards social security scheme, and third one is pension to retired person. Then OS. In OS we are also having three components. One is dividend, then corporation tax, and undistributed profit. So these three components are the component of profit. Another component of operating surplus is interest, and next component is land. Land is given rent, royalty, copyright, like this. All these components are of the operating surplus. And mixed income, it is the income of all four factors of production together, that is land, labor, capital, entrepreneurs. The example of the mixed income is private clinic, shopkeepers, mechanic, auto repairs, etc. to mixed income. So when we add these three components together, COE, compensation of employees, OS, operating surplus, and mixed income of self-employee, we will have NDP at factor cost. So by income method, this is also known as domestic income, and if we add this in this domestic income, if we add net factor income from abroad, NAFIFA, net factor income from abroad, we will have national income. Net factor income, NF, factor income from abroad, we will have NNP at factor cost, which is also known as national income. I hope you understand these two methods, income method and product method. So in income method, we will have COE plus OS plus MI, which is equal to the COE, wages and salary in cash and kind, in COE, employer's contribution to social security scheme, pension to the retired person, and OS, it is the income from property and entrepreneurship. That is, one is profit. In profit we will have dividend, corporation tax, undistributed profit, and then second one is interest, which is given to the capital, and third one is rent, royalty, and which is paid to the land. So when we add these components COE plus OS plus MI, we will have NDP at factor cost, which is also known as domestic income. And when we add in this domestic income net factor income from abroad or NFYA, we will have net NNP, net national product at factor cost, which is equal to national income. I hope you understand these two methods. Thank you.